Hi, I'm Eric Crawford. For 15 years, I worked as a stock analyst, valuing companies for a global investment bank. Today, we're going to take a look at one of the hottest names on Wall Street, Nvidia. The company is synonymous with AI. They have triple-digit revenue growth and profit margins that are the envy of the industry. But how sustainable is that? And what's the company actually worth? Today, we'll take a look at answering those questions. Let's get started. So in order to value Nvidia, we need to have a sense of what their earnings per share are likely to be. And in order to do that, we need to have a sense of what their revenues and profit margins are likely to be. And in order to do that, we need to have a sense of what their strengths are and what the evolving competitive dynamic is likely to be in the years moving forward. I'm sure most of you are already well aware of who Nvidia is and what makes them such a great company. But for the few of you out there who may just think of Nvidia as a stock that's made a lot of people a lot of money recently, here's some quick background. Nvidia's been around for decades. They made their mark initially designing specialized chips for video game graphics. The key innovation for them was that they designed their chips to process information in parallel with one another. So multiple processes could be done simultaneously, rather than conventional chips that processed information in a linear fashion, one after the other after the other. Now, as time passed, a number of applications have come to find this design of chip that Nvidia pioneered perfectly suited. One of the first applications was cryptocurrency, and now artificial intelligence. When you think about it, there are trillions of calculations that have to be done in artificial intelligence. So any incremental improvement when it comes to timing or energy efficiency pays huge dividends in the long run. Now, besides just incredibly designed, innovative chips, Nvidia also created a specialized programming language called CUDA, C-U-D-A. This specialized programming language has created an ecosystem around Nvidia's chips, strengthening their competitive position going forward. And so, Nvidia finds itself in a bit of a Goldilocks moment. There's just been a wave of demand for AI chips and limited supply. But that is about to change. Now, bear with me while I use a metaphor to bring home the point about competition. Who wouldn't rather watch this over me talking into a camera? So the Great Salmon Run is this wondrous event that represents a tremendous opportunity for the ecosystem around it. In the metaphor here, the salmon represent the huge investment being poured into AI. And our friend here is Nvidia, perfectly positioned atop Brooks Falls and Katmai National Park to best capture the opportunity. Of course, we know there are other players in the space that are looking to unseat Nvidia from its perch. Google, Microsoft, Facebook, AMD, Intel, Huawei, Qualcomm, startups, and others are all investing heavily in their own chip designs, trying to make up for lost time and secure a bigger share of the opportunity. For now, Nvidia is in the sweetest of sweet spots. Yes, Nvidia has a tremendous first mover advantage, and they are capitalizing on this Goldilocks moment. But it's important to note, if we take a look at what Nvidia spent on R&D over the last 10 years, it comes up to a total of $44 billion. That's how much they spent on research and development over 10 years. To put that in perspective, Google spent that much on R&D just last year. As a matter of fact, they spent more than that. They spent $45 billion. Again, just in 1 year. The competitive landscape for Nvidia going forward will be a lot more competitive than what the last 10 years looked like. That's the high-level overview of Nvidia's strengths and the competitive dynamic they're likely to face moving forward. Now, let's take a look at the model I built, where we'll review revenue assumptions, profitability assumptions, and we can get a better sense of what the company's earnings potential might be going forward. Okay, here we've got Nvidia's income statement. I have 10 years of historical results here and projections going out 5 years. Let's start on the revenues line first. For the second quarter, management has guided to revenue as high as plus 2% sequentially. I think there may be some conservatism there, so I'm baking in 4% growth for the second quarter at least. And with the launch of their new Blackwell chip in the second half of the year, I'm modeling a strong back half. The numbers here just represent the sequential total value in revenue growth. The year-over-years aren't that, they're so big that they aren't that helpful. But I've got the revenue growth year-over-year starting right here. Compared to consensus, my estimates are above average. Let's see, consensus here. The average estimate for revenue in the quarter is 28.47. I'm at 29, just slightly above average. For the year, the average estimate is just north of 120 billion, and I'm at 124. For next year, I'm at close to 183, and you'll see the consensus number is 163. So let's focus a little bit on that consensus number for next year. So I'm at 47% revenue growth for next year. That's based on what TSMC has said on their most recent earnings conference call. For reference, they're the manufacturer of the chips Nvidia designs, and TSMC is expecting 50% growth in AI chips annually over the next 5 years. That 50% growth, at least for next year, seems like a reasonable place to start. I think you'll see some pricing pressure start to creep in and some market share pressure intensify beginning in 2027 and continuing moving forward. So by fiscal 29, I have Nvidia bringing in $315 billion in revenue, more than 5 times what they generated 5 years prior in fiscal 24. But as we move to gross margin and operating margin, the picture begins to look less rosy. All this competition means it's going to be more expensive to recruit and retain the best talent. Nvidia will surely see some talent departures. That's going to adversely impact gross margins. Besides the fact that their business has historically been a mid-50s to low 60s gross margin business, as we see here. By fiscal 29, I've got gross margins receding down to 60%. Meanwhile, Nvidia's CEO has already announced that the company will be accelerating its product development schedule, putting out innovation every year rather than every other year. In an environment that was already going to require higher R&D expense, the accelerated timeline for innovation exacerbates this, and I'm modeling a significant uptick in R&D going forward. As a percentage of revenue, still looks totally manageable. 6.8% in 2029, fiscal 2029. But you see here, compared to what it's been, that's quite a lot of growth. Not quite tripling, but certainly a significant increase. That said, for all this increased expense, I still have Nvidia operating margins above 50% by 2029, down from this year's 63%, but still super attractive. All in, I'm forecasting net income of $141 billion by fiscal 29, or in fiscal 29, I should say, equivalent to $5.66 in earnings per share. Yes, the company has been buying back shares, but it's really only been to mitigate the impact of dilution from employee options. So share count, for right now at least, I have flat. Now, how do we translate that to an estimate of what shares might be worth? Well, let's take a look here at how other trillion-dollar market cap tech companies are trading. Based on earnings projections and price-to-growth ratios, I was able to calculate a regression formula that pretty well captures the relationship, as you can see in this chart. It's got an R-squared of nearly 97%. So on the x-axis, we have earnings growth, and we have the PE ratio over growth, the PEG, here on the y-axis. So based on our model's forecast of 12.8% EPS growth in fiscal 29, that implies that investors, in today's environment at least, would be willing to pay a price to earnings ratio of 36 times. Basically, 12.8% is right around here. Go on up to the line. It would imply a PEG ratio of 2.82. So obviously 2.82 times the 12.8, you've got yourself a PE of close to 36. And 36 times our estimate of 566, we get an implied share price 4 years from now of nearly $204 a share. Now, we know $1 today is worth more than $1 tomorrow. So based on Nvidia's risk profile, they have a weighted average cost of capital of 12%. So we have to discount that $204 share price by 12% for each year. And in this case, we're estimating the price 4 years out. So that leaves us with a price today of roughly $129. And looking at where shares are trading, this afternoon they're at, give or take 126. The estimates in this model are baking in a scenario pretty close to what the market is currently pricing in. I'll be making the model and the work underlying the assumptions available on my Patreon, and I'll also be providing a monthly newsletter. And of course, the models on companies featured in future videos as well. So if that sounds appealing to you, please consider heading over to my Patreon and subscribing. And finally, if you haven't already, please like and subscribe and leave a comment below if there's another company you'd like me to run an analysis on, or if you think I missed something in this one. Just remember, if you think my estimates are way off base, that's what makes a market. Until next time, take care.